a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. We are live. It's Friday. What a week, huh? Talk about volatility. It really does feel like 2011 when seems like whenever Europe gets involved, things get crazy. We don't know how to handle the whole European scene, even though most of us have some kind of roots from there, right? It's like there's so many variables to look at that it's impossible to figure out. And I wouldn't want to run the ECB, I can tell you that. It's a lot easier to run the Fed. The Fed doesn't have to worry about bailing out California and all that. They just stick with what they do, sort of. Although I saw an interesting story that Janet Yellen was talking about the inequality and her concerns. That's now the Federal Reserve's job.
Everything's socialism now.
She is a Berkeley professor. Okay, I lived in Northern California, so if anybody know a little bit about the Berkeley composition, it all makes sense. But I don't believe that's in the mandate. But most of what they've been doing in 5 years isn't in the mandate. So I guess when Obama came in, he said he's going to fundamentally change the everything. So that's what's happened. We have a lot of things, and some of it was through what appeared to be necessity. And I guess never miss out on a crisis, right, to change things. Us lemmings out here just go along with whatever's happening. But crazy short covering rally. We're going to bring up the screens here in just a minute in the background, just so you can see what's going on. Matter of fact, I'll go ahead and switch our screen over here now, and just so you can see the market. We were up 32 handles. I don't know if you folks remember, but what was it, Tuesday morning? Wednesday morning we were at 1820. It's now 1895. So we're 70 handles higher. And as I've been talking the last 2 days in commentary, I'm going to show you a couple charts here in a minute. This bear trap thing. This is classic. And matter of fact, I had this synapse getting ready this morning to come into work, and I had this synapse. I have not seen this pattern, and you folks maybe will find this interesting, since 1987. This is we had a steep drop and rebound on a rally. Think about what's changed other than I mentioned that what's his name, James Bullard came out yesterday. He was the hawk on it, so they said send James out to the street, tell him that QE or we're going to keep rates down, tell him something, because he's always make him dovish, and so we saw a bid come in after market was down almost over 1.5% early on yesterday, and it just continued to rebound. And I can pretty much tell you that nothing's changed. We'll go through a couple of reports that came in, but what's happened is massive short covering. There was a lot of short selling going on early in the week. Mitch and I were just talking right before we came online, supposedly the Ebola thing. Well, it's getting worse. There's like 5 more people quarantined. Now there's a lady that worked in the hospital on a cruise ship. Okay? I'm sorry. That sounds like a bomb. I mean, should that thing be let? I'd hate to be on that boat. I mean, should they let that thing back on shore? She's not showing any symptoms, but all of a sudden she gets on cruise ship. And, oh, yeah, by the way, I work in the lab that handled Duncan stuff, so I don't know, folks. I don't get it, okay? But
What I
anyways,
just thought was so comical was that, if you turned on any of the major financial news networks on Wednesday, people that should be a little bit more better tuned into things, that's all they were talking about was Ebola.
right.
And then they were talking about how, all these safety measures have been taken. But we keep getting out more and more of this news information as to really how bad this thing could potentially get, really already is
Yeah.
in some regards. But the market's shooting up. And so it's clear that is not the driving factor as
Well,
to what is
Well, it
doing
never,
short coverage.
yeah, it was never the driving factor in downside
Right.
or upside. But
Right.
what is driving the market is these evil hedge fund guys trading out there in the high frequency traders. So I sent an email to Squawk Box Europe last night because it was just ridiculous. All of us are part of this community, and when I see a news network that thrives on what we all do and the markets, and seeing one of the people just kind of trolling elements of the market, which was inappropriate, I had to call him out on it last night. Bottom line is there's a lot of emotion right now, and this is important to talk about, even though you may not want to talk about it. It's important, and so the bottom line is there's a lot going on. There's not going to be any QE in Europe, by the way, because that's just not part of the game. They don't have any way to do QE. The Germans, rumor is that if they even try it, the Germans are going to step up. They already have a ruling that says it's not legal. They don't have the mandate. So the reality is Europe's in big trouble. Nothing's changed. This is a short covering rally. I'm going to show you a couple of charts in a minute that I mentioned. I think the headline was bear trap set. And this is exactly, I told you 2 days ago in commentary, after the reversal we saw on Wednesday and we closed down 15, it was clear that there was a minor reversal going. We're going to get 3, maybe as many as 5 days up. 1820 will be retested. It will be taken out because of the way the pattern's setting up. And this is just so classic. And when we start to go through the PPMs and stuff, no reaction to momentum at all to this rally. So I would say, for a lot of us to have cash, one of the things that also that since we bounced so much, it's not as dramatic as it was yesterday when the market closed up 27 cents. But we're literally, what was it, 1840 was where we started this year. We're 18.895.
Yeah, 1848 is.
Yeah.
1848.36 is.
We're
the
40
last year.
handles. We're one of these days right now off of where the year started.
Yeah.
So the bottom line is this year has been a disaster in so many ways. Asset class is moving around. We've seen the small caps are rebounding, but they should be. They were down almost 12%, I guess, at the worst, maybe a touch more. So they're rebounding. You're seeing all that stuff. So let me show you. Well, let's start the show and do like we usually do. Is that the fact is, I want to go through the daily, weekly, monthly. Then I'm going to show you some of these technical patterns that are setting up. I think are important to do. So, and the bottom line is, here we are at the daily graph. You can see we are coming right up on this 10 period moving average, and I'll bring up the numbers on the screen for you, but I want you to see what's happening here. And I know those of you who watch the show a lot, you'll know this, but the down below here, PPM1 is minus 0.38, major downtrend mode, minus 2.8 on PPM2, and minus 12 because the 40 is just rolling over. The best thing, if you were a trader, which I am, you would put on, anytime you get close to this 10 period moving average at a 0.38, there is only a 20% probability it can get over that. Now it's 1907.62, but it's dropping between 7 and 9 points a day. So that number is 1899 on Monday. And the momentum might change a little bit. We'll have to see when we get the first tick. But like I talked about before, all of the numbers that are coming on, you're still getting an acceleration. If you look over on the right-hand side here and look at the PPM1, it's just coming back to its first derivative. It's in this downtrend and declining momentum. So this rally has not a lot of legs under it, other than it's an opportunity. Everybody's talking about the opportunity to buy. This is an opportunity to sell here. And so if you do have some things, some of the folks that we talked to after the show on Wednesday that were a little concerned when things were so crazy and we're down at 1820, our suggestion to you is a couple things, and I think this is significant, is that if you did not do some trades on Monday that should have been done, don't do them during the week, because if your customers have a clue that you usually do things on Monday and now you're doing something on Wednesday, you just set yourself up for another explanation. So you're better off waiting until the following Monday, and in this case, depending, it looks like Monday would probably open a lot better than where you would have been panicking on Wednesday. So you always have to check the gut, and I've learned how to trade when my gut gets really tight and I think, oh boy, here it goes, to take and fade myself and fade the other way on some of these trades, because that it's really emotional. When you start to feel the stomach tighten up, you know that you're about to make a mistake. And Murphy's always in play on those days. If you do nothing, it keeps going down. If you do something, it goes up. So especially if you're find yourself on the wrong side. So Monday's always the best day to go back and do it. And in the case of a lot of people that we're talking to, there was very small pieces of their portfolio left. They were in 20% piece. And I'm not sure what just happened here. My screen I just lost everything on my screen. Interesting. There we go. Not sure what that was. That was blackout.
There's Murphy's Law right there.
Yeah, my computer's got Ebola. No, I'm just joking. That was a bad joke. Anyway, so all of these elements. I lost my train of thought now. But we're just not seeing the rebound in momentum. So let's go over to the daily or the weekly chart and take a look here. Now, this chart is a little more interesting looking in that you've got a rebound, but you're still under right now. The 200-day, 40-week moving average is 1905. So the fact that this is what happens in psychology and markets. The fact that we were at 1820, it feels like we've rallied. By the way, we haven't. We're at 1892. We were 1907 last week. This is still a lower close. And the perspective is that we spiked out, and maybe we did, but there's a lot more work to I think the other day when we printed the 1820, I looked at futures. We traded 133 futures contracts at the low. There was no trading down. There was really thin. And one of the elements that we dealt with all week was there was no liquidity. Mitch and I were talking, having my basically level 2 screens up. There's no bids or offers on anything. These things are just jumping 200-point ranges on the futures. You couldn't trade them this week if you're doing scalping or things like I do a lot of times. You couldn't trade. It was impossible to trade those markets because there was no stability in how they were trading. It was crazy, 200 and 300 points. They'd run them up 500, back down 600, all over the place. And that's why it's really been a lack of liquidity on this thing. And today we're still seeing, and this is the other thing, the 3-day range is pushing up at 40 now. I don't think I've ever seen it this high. And yesterday's range was 41.01. And today we're pushing this is like a low volatility day. We only have 34. So, we've got a pretty good range. This volatility is pretty high. The VIX index is a different measurement than that's more of a sentiment measurement, and you've got some different plays in there. I use a pure number to come up with a volatility, which is, I look at a 3-day average range, which tells me approximately what's likely to happen. So when we generate all of our ranges, our S1 to the extreme and R1 numbers, all the resistance and support numbers every day, that's done from an algorithm. It works off the 3-day average range, and then it figures out where the likely points are going to be. So we've already exceeded R3 today, which is 93. Our the extreme is 1902.25. So we're really not. We probably won't get to that level. I suspect that everybody's pretty tired. They'd have to run this thing another 15 points to get over that 10-period moving average, or to get back above that. I guess it's certainly possible, but it seems somewhat unlikely. We're up 278, and of course we were down 460 at the worst. So, but the PPMs are minus 20 now on the weekly. So we were much worse numbers showing that, but the bottom line is that's a minus number. The 10-period moving average is rolling through. Let's take a look at the numbers real quick again. The 10 period here is right at, so the fast average in 1967, so it's above this thing quite a bit. But when we start to look at, let me make sure I got the right number. Yeah, 1969.95. So it is declining only at about 6 points per week. And when I show you, once I get through these charts, I'm going to go through and we're going to talk about this bear trap pattern, and try to show you exactly what is setting up here. And this is classic technical stuff. So let's take a look at the monthly, and the monthly will show you. The monthly is going to show you we're back up 0.23. I don't know if you remember, we were minus on Wednesday. We did a little impromptu 30-minute show. On Wednesday, we were minus 0.2. And so we backed back up all the way to the point where we're almost at a trend mode again on this. But there's a different scenario, if you remember, on the monthly, is that it is now only going up at 0.23, and we're back at 1.06, and we're still 1% below on the PPM 3 right now. We're 0.91. So all of this is happening. It's this particular trade is about this convergence of the moving averages that I've been developing, and I want to cover something here that I think I'm going to go off screen so I have a full chart here. And one of the things that is happening here, which is the same thing that's happened before. We broke down and we went to the lower moving average in the pattern. In this case, we're likely to stay between the 21 and the 10-week moving average. And if you notice here, we get below these averages and we sandwich between them, and then when they break through the lower average, then they start this decline. And I figured out last night that the 2008 decline was 15 months, 40-some%, like 46% top to bottom. And then the 2000 number was 25 months. It was much more elongated. And so we're looking at, once this thing starts to roll over and these signals start to happen, which the process has already begun, I've been talking about it for probably 2 months now, is that we're looking at 15 plus months probably on average. I went through in 1998. There was another. I think it was 14 months high to low. I could bring that up, but there was another quick drop. But all these patterns that keep happening are, like I said before, it takes 6 years to go up, 5 years to go down. So some of the longer term. 6 years to go up and 15 months to go down. And so the targets on the downside, I've talked about this, is 1780. This lower average is right now 1572. And we're going to see these numbers at some point. And once again, this is, we're about 3/4 or 60% through this month. We're at the 17th. The time we start on Monday will be the 20th. So we're in the final 10 days of this month. So the next bar will start. But as we go through this process, you're going to see one bar at a time. And this momentum you can see over here on the PPM 1, we've broken through both the first and second derivative. And I need to bring up this graph here real quick. And we have broken through both derivatives as well on PPM2, and I have to tell you folks that this does not happen in the bull market. It's funny, I was on LinkedIn, some other places looking around, I see all these comments. Is the market knocked down, or was it knocked out, or is it busted? It's in the process of starting a pretty major decline. I don't think this is going to end like Janet Yellen talking. Last night's headline was "Talk is cheap," and what we're seeing from the Fed right now is they're trying to posture and jawbone. It's called, just jawboning the market. Say, oh, we're going to be dovish. We're going to be, we're going to keep this thing going. Just someone, please call us, send us an email, and tell us what this stimulus has actually done. If I brought up some of the housing numbers that everybody's all excited about, this market is terrible, to say the least. And those are the things that you want to see. And in fact, in a second here, I think I can bring it up. I have it set up. But the bottom line is, this chart has rolled over. Momentum is rolling over. When this thing's happened, the last time this happened, November 2007. This is the setup. And we're starting to see the same patterns. And I haven't used the whiteboard, but let's show you some things on a whiteboard here. That if you take a look at this, you're going to see these points where I'm putting the arrows right now, that we're seeing the same points where we're starting to roll over. These indicators are going to start to decline. And when they decline, they go negative. And when they go negative, that means there's a downtrend. Right now, on a monthly, because of the numbers, 0.25 it's about 0.6 plus where there's a trend. So if you notice, we came fairly close down to the 1780 number. We got down to 20 on the spike. If you recall, the range was 1818 to 1780 was the target range for this move. Anymore, everything seems to be compressed. So we actually saw that number get hit, or 2 points off. Like I always say, you can predict where the market number ranges are. The market will tell you the right number. So the right number is 20 for that target for this first move. We get this right shoulder bounce, and then you get a retest. You got to go back and test that. Just like if you recall, when we bounced all the way off of the mid 1900s, went to 2019, and then fell. We're still, if you look at it, we're still 130 points off of the peak. So while I'm looking at 28.59 up on the S&P, while that looks and feels like the market's doing something, it's really not. It's about perspective, and remembering that what we're looking for is the next trend, and the next trend that's going to emerge is a downtrend, not an uptrend. This thing, it's not an opinion. All the stuff that's happening that I've drawn here, this is what happens when. And I've been talking. I set it up pretty good for several weeks, so I kind of beat that one down pretty good. I think I can show you real quick here, and let me go to. Let me get rid of the whiteboard. I got a black screen here real quick, but let me. I want to show you something here. Actually showing you my iPhone here, but I have an app here that is pretty cool on the economy. And so this is what your monthly trend in. This is non-farm. Let me get off of this. I want to get to the real estate, because this is what everybody's excited about on the real estate. Excuse me 1 second here. There it is. This is the recovery in real estate. This is what almost $3 trillion of buying mortgages has done. Virtually nothing. You can see the number of starts. We were at almost 2.5 million starts and you know, and we're way below that. What was it? 1.01, Mitch?
Yeah.
So
1.017.
yeah, so the housing market is not recovering. And like I said before, and we went through all the central banks on Monday, I think this is important, as all the central banks, there's nowhere the Fed can expand their balance sheet. They're not going to announce another round. That would shock, I think, everybody in the world. If they did, it would be the one time it would be the worst thing they did, my opinion, this is an opinion, is that what would happen is it would just confirm how bad things are that they have to step up again. And this could be the time where it backfired on them, where there's not going to be, you know, everybody that the Federal Reserve is going to continue to save you every time the market goes down. I mean, is that really their mandate, to keep stock prices going? They seem to be responding to that. You know, I don't know why this is the case, but I mean, there's, you know, let's all hope that this Ebola thing gets under control pretty quick. But it feels to me, I feel, maybe it's just me, but I feel a lot of anxiety when people are living life that don't even know they've been exposed potentially to this, and they're going on. So, you know, who knows where, you know, this goes. And I just, there was a post on Twitter last night. I know here's the Ebola thing again, but just the whole process, this thing is brutal. Even if you get through it, you're not through it, because you're just not going to get any. I guess after the disease is more disease. If that makes any sense. See if I can get the screen back now that I went live. It's doing that again. That's interesting. There we go. So let's go and take a look at this chart that I was talking about here, if I can find it. I certainly had it up there before we started the show, and now I don't see it.
I think it's at the bottom there, Bob, right next to the folder icon.
This guy, yep, good call. So this is stages of a bubble. And, you know, we looked at the long-term charts on Monday with the Dow Jones and everything that's going on with that, with how it's parabolic. But this is the bull trap. This is that right shoulder. This is what we're setting up right now. So you get a steep fall, you get a rally back, and then you get the next fall. Now, I'm not, you know, I mentioned 87 because it's the pattern that happened in September 16th, 1987. I've been writing newsletters and doing research for my own firm and for regional firms, and even worked in Merrill Lynch research for a while. And I can tell you that this is the pattern that I saw when I wrote a newsletter on September 16th. And I've been saying, I realize I'm echoing myself, that I said that there's no reason to own stocks in the U.S. right now, and there's a lot of risk. And that was the same statement that I made back in 1987. And I also have to propose, and I haven't talked about this, is every time, not sometimes, every time, and since I've been in the markets in almost 37 years, is each time there's a new Federal Reserve, there's a challenge, and there's a big debacle. Greenspan came in, within months, the 87 crash happened. We know what happened with Ben Bernanke, and then, you know, we saw Greenspan had two fun events. He had that and the crash, the 2000 situation. Bernanke came in, of course, we saw the 08. There seems to be, on every change of the Fed, there seems to be a new crises of some sort. So why is that? Is it something that their predecessor did that set them up? And, you know, it's the old thing, Bush did it. But, you know, is that the case? Or is there, when these new policies come into play, that it becomes so confusing? I have no idea. I don't think Janet Yellen's a very good communicator, personally. I don't think she's doing a very good job of telling everybody what to do. They're trying to do this transparency, but it's gotten to the point where they've told everybody so much that maybe we know everything, but their story conflicts. And then I've never seen this point. I guess maybe it's not as focused in the past is that each one of these Federal Reserve, these presidents and different members of the Federal Reserve are out just talking all the time and doing this and trying to send their message. And it's like, I don't know, maybe this is the era of political correctness that is coming into play here. I'm not sure. But these are the kind of patterns when you see, I'm going to bring up this Dow Jones chart again real quick so you can get the perspective, is this chart here, when you can see that I'm only showing you from 1997. Let me get off screen and make this full screen here. This will help a little bit of view here. And when so you can see from 1997, you can see how this thing is breaking down. This is just without PPMs and all that. When I start to squish this down, all of a sudden you see the real magnitude when you look back to 1925, what's happened. And this is, like I talked about before, just bringing up the whiteboard to draw this out again. This is pretty typical, and just for those, if you look at, we've crossed through this little trend line here, which is not bullish, it's actually negative, but this is that bugle formation I talked about. And typically what you're going to get here is some move like this. You're even going to go back to this high. Mitch and I were talking about the other day, this is the Dow Jones, we're looking at the S&P, and we're looking at a range around 1480 to 1342 is a downside target longer term. And you know, I remember in 2011 when I was talking about 1905, everybody thought that sounded pretty crazy because we were at these numbers we're talking about. We were at the 1400 handle level. So this market will typically go back to the top, and if it went back to wave 4 previous degree, then you're looking at, you know, something even bigger. And this is a monthly graph. The chart that we're looking at is not quite 100 years. It's about 90 some years looking at this chart. So the realities are, this is something, I keep talking about this generational high. I believe there's going to be a lot, because of the magnitude of this chart, there's going to be a lot of opportunity to trade this thing as the years unfold. So it's not all over. You don't close up your shop and the financial markets are done. But there is some serious things to deal with, and you know, we could bring up the debt clock. We could do a lot of stuff. There's a lot of things that we all know are happening, and I keep saying at what point is it on the debt do we wake up and realize what we already know, or acknowledge what we already know, which is we can't pay this off. And so you live with this everything has been levered up across the planet, and that's why I went through all the central banks on Monday, because it really gives you a perspective. You start seeing what's going on. And as far as, you know, I said it earlier, but QE in Europe is not going to happen. They don't have the infrastructure. The ECB can't do what they want to do. And the funniest headline I saw earlier in the week is that Cyprus was all excited because they were going to buy sovereign bonds. That's like buying, you know, Rhode Island bonds or something. You know, one of the smaller inactivity things that there is in this country as far as the state goes, as far as adding to GDP. So it's a non-event, and they're not going to buy those bonds. Like I said, the Germans are going to block that. So if you recall that chart, I don't have it in front of me right now, but that is something you need to be paying attention to. At the ECB, there isn't much they can do with the whole European situation, and you know, they don't need liquidity. They need banks to lend, and that's why they're forcing the rates like they are from the Bund that's bounced. And that's the other thing we're going to go through a minute ago, because we saw this huge spike down to 1.8 something on the 10-year, and it's not there anymore. So everything's changed. So, but one of the things that hasn't changed is I don't think the magnitude of these deflationary forces that are in Europe, that are here, that are in China. I mean, China, we talked about this on Wednesday, 1.6% inflation rate in China is bad. If they go negative, they live on the whole concept of inflating that bubble over there. So we're looking at some pretty serious issues as we go on. So let's go back and let's take a look at we'll go ahead and take a look at some of these other charts. Let's go and look at the 10-year. What an opportunity to knock this thing. So the low this week, let me bring the numbers up on the screen, go full screen here. The lows for the week here, 1.86. We are now 2.2. Talk about a move in bonds. That was a very large move in the bonds. So everything that was panicked has changed. So I expect that was probably the spike, and the higher yields are going to start to come into play. So everybody's going to have to deal with, if the bonds continue back up, the fact that we get down to 1.8, it didn't stay there. Like I said, what a great time to sell your bonds if you had some to sell. The bottom line is that yields probably spiked out there, but we don't know until we see a little more of this chart. But we're still looking at a minus 80 on. If I bring up the ppms, let's see. I don't have this thing live, so it's calculating. It'll take me too long to set it up. But we have negative 80, negative 40, and negative 66 on ppm 1, 2, and 3. So these are steep downtrends. So what it tells you is that the yields are probably not going to get much more above the 230 range, 225 to 230. We've bounced back to pretty much the resistance point, and that's going to take several weeks, at least 4-6 weeks or more, to stay down at these levels for this downward momentum to bleed off. And so right now there's still a big, huge downtrend in yields, but what in this case I think all it means is that we stay below 230 now. 220 was the old target, but also on the screen here you'll see the low target was 210 to 201. Well, we spiked below that, and now we're back at the 2.2 level. So this is probably satisfied all the technical aspects of this market, and now we consolidate and we decide where the next move comes. The Fed is going to move these rates higher, and I guess one of the numbers, for some reason I didn't even catch my eye, Mitch. Did we look at what the jobless claims were yesterday? I was so busy with other stuff, and just didn't even.
Yeah, the jobless claims came in. The consensus that they were expecting was 287. Actual was 264, and this was actually the lowest since April of 2000. So it was a pretty positive number in the sense that numerically it's the lowest that we've seen in a very long time. Of course, the Senate can look at it and say, well, look at the shrinking job pool, and so this is just what you'd expect. But
and not to mention, all these numbers are going to be revised, and it is the last reports right before an election. So just remember what's going on here. We've seen some pretty crazy things in 2012. So this is pretty. That's the other thing. We got big time battleground going on, as everybody knows. So from there's a political backdrop here too. So anyway, let's go on to one of the things we haven't looked at much, which I guess is the appropriate time as any, is gold. So through all this, how is gold doing?
Yeah.
And I'll just use GLD and this is on a weekly basis. So we have rebounded off the lows. We still don't see much. We're minus 0.56, minus 2.7, and flat. So we have the downtrend in place here. So I'll go ahead and put numbers up. Matter of fact, let me get Mitchell off the screen, actually both of us, so we can go through this. The numbers that we're seeing here on gold this has been a very long basing period. We do have some downward targets for gold, down to 1,061, I guess. 1,014 is about, or 49 is the bottom here. So we got down to those numbers. We got down to 114.61, which if you convert it's a 1146. So we got down to these numbers here, which are into these support levels, and then we've rebounded back up since then. As we can see, we're off of those lows a bit, but the bottom line is gold is trying to make a turn here, which is somewhat interesting. So we're looking at still, like I said, negative ppms, but you can see that they're turning up here on the far right hand side, and there isn't still an upward slope to the ppm 3, and it's above its second derivative, and so it's right at the range where this is pretty typical how it's going to act. If the support's going to hold, we need to see these things pull up. So maybe there's a rally coming in gold for a little bit, but there's so much congestion here. You're going to be lucky to get through these highs here, which are around the 1250, 1270 level. It's going to be pretty substantial resistance